The largest fraud most people can't explain, Bernie Madoff's Ponzi scheme. You've probably heard of it, but do you know how it really worked? In 2008, Madoff confessed to running a $65 billion fraud that devastated investors and brought down several financial firms. But why did so many smart people fall for this? Madoff promised consistent returns year after year with no underlying investments to support them. He told clients their money was safe in high-yield securities, but was actually just moving funds from new investors to pay earlier ones, essentially a giant shell game. When the financial crisis of 2008 led to fewer new investors, the scheme could no longer sustain itself and collapsed. So how did Madoff keep his scheme running for so long? Let's break it down step by step. Step 1. Madoff took deposits from investors. In the early 1960s, Madoff began his operation with friends and family, promising them consistent returns of about 10% per annum. This rate seemed too good to be true, but was difficult to resist due to the lack of transparency in investment schemes at that time. Step 2. The illusion of legitimacy. He established Bernie Madoff Investment Securities LLC on Wall Street. The office appeared impressive, complete with prestigious signage and a high-end location which lent an air of credibility to his claims. People were convinced by both the physical presence of the office and its well-known address. Step 3. The referral system. To maintain the scheme, Madoff encouraged existing participants to attract new investors. This built a network of trust and provided a continuous influx of funds necessary to pay earlier investors. Now here's where it gets tricky. How did Madoff keep paying returns? Simple, he didn't actually invest the funds. He took new deposits, used them to pay old investors, and kept the rest for himself. It worked as long as he had enough new investors coming in to cover the payouts. But how could so many smart people be fooled? Here's why. 1. Consistency. Madoff's returns were consistent over time, giving clients a sense of reliability and steady profits. 2. Exclusivity. He made it seem like only select individuals could access his investment opportunities, fostering an aura of prestige and exclusivity. 3. Credibility. His firm was located in the heart of Wall Street, which lent an air of legitimacy and trustworthiness to his operations. People assumed that such a prominent location indicated honesty and integrity. Now let's look at the numbers. In 2008, Madoff admitted that the losses from his clients amounted to approximately $17 billion to $55 billion. How did this happen? He convinced investors to leave their money with him for years without providing any actual investment details or real profit statements. Instead, he provided them with regular payouts and fabricated statements showing consistent returns. But what about the individuals who entrusted their money to Madoff? Why weren't they able to detect the fraud? Let's talk about one investor in particular, Frank Avent. He invested a significant amount of money with Madoff starting around 1967. Over 3 decades later, that investment had grown substantially due to the Ponzi scheme's fraudulent practices. But when Madoff confessed in 2008, Avent lost everything. How did this happen? Let's break it down. In the early years, Bernard Madoff made small gains for his investors from what appeared to be his investment activities. He allowed them to reinvest those gains and continued to report consistent returns on paper. By 2008, some investors had $200 million or more tied up in the scheme. When the scheme collapsed, they lost everything. So why did so many people continue to invest with Madoff? Because they observed what appeared to be consistent returns and trusted Madoff's assurances. They rarely, if ever, inquired about the sources of these returns or the methods used to generate them. Now let's talk about the bigger picture. How did Madoff get away with this scheme for decades? 1. Regulatory oversight. The Securities and Exchange Commission, SEC, tasked with protecting investors, missed several opportunities to intervene. 2. Lax enforcement. Multiple warning signs and whistleblower tips went unaddressed despite potential red flags. 3. Complexity of financial markets. Even experienced professionals found it difficult to penetrate the deceptive layers surrounding the scheme. So what does Madoff's Ponzi scheme teach us about investing? 1. Don't trust too easily. Always ask questions and verify claims. 2. Diversify your investments. Don't put all your eggs in one basket. Diversification can help reduce risk by spreading investments across various assets. 3. Understand how returns are generated. If something seems too good to be true, it probably is. Be wary of exaggerated or inconsistent return promises. But there's another critical lesson, the importance of asking tough questions about where your money goes. Remember Bernard Madoff? He never requested proof of investments or returns from his clients. Had they done so, things might have been different. Now let's discuss the warning signs that could have raised red flags. 1. Consistent returns. If someone promises steady gains every year with no losses, it's often a sign of fraud. 2. Lack of transparency. No one can consistently promise specific results without being transparent about how they achieve them. 3. No due diligence. Savvy investors demand to see the underlying investments and verify claims through thorough investigation. But why did the SEC fail so badly in addressing the Madoff Ponzi scheme? Here are some key reasons. Underfunding. The regulatory agency lacked sufficient resources to thoroughly investigate potential frauds. Inadequate staffing. Insufficient numbers of qualified professionals hindered the detection of intricate fraudulent activities. Political pressure. Regulatory bodies frequently encounter pressure from influential financial entities, which can impede effective oversight. So how do we prevent another Madoff? 1. Enhanced regulatory measures. Strengthening oversight and enforcement mechanisms is crucial to prevent fraudulent activities like the Madoff Ponzi scheme. 2. Investor education initiatives. Educating individuals about the risks associated with Ponzi schemes is vital for protecting investors' assets. 3. Increased transparency requirements. Mandating full disclosure from investment firms can aid in identifying fraudulent practices early on. But let's be clear, the Madoff scandal wasn't just a failure of regulation. It was a wake-up call for all investors to take responsibility and protect their own investments. In short, Bernie Madoff's Ponzi scheme is a cautionary tale about greed, trust, and the dangers of ignoring red flags. It illustrates how even in finance, the safest path is not always the most profitable one. This is educational and historical, not financial advice. The Madoff scandal exposed deep flaws in how we handle money, highlighting just how vulnerable investors can be when they aren't vigilant. One of the key lessons here. Trust needs to be earned through careful investigation, not assumed based on reputation alone. People often invest without doing enough due diligence, putting their faith in well-known figures and institutions without verifying claims and performance records thoroughly. Take a look at Madoff's victims. They weren't just everyday folks, they included high-net-worth individuals who should have known better but still fell for it. This shows that relying solely on your own intuition, no matter how experienced or well-off you are, is not enough. Always dig deeper and verify claims with independent sources. Madoff promised steady returns regardless of market conditions, which is a significant red flag. Consistently outperforming the stock market over time without exception is highly suspicious and unrealistic. No investment strategy can guarantee positive returns in every market condition indefinitely. Consider this. If an offer promises exceptionally high returns with no associated risk, why aren't there more people taking advantage of it? Something doesn't add up. Another critical aspect of the Madoff scandal is how long it went undetected. Despite multiple whistleblowers raising alarms in the years leading up to its collapse, these warnings were largely ignored or dismissed by authorities and other watchdogs. This underscores the importance of having a robust whistleblower protection system and encouraging insiders to come forward without fear of retaliation. Moreover, there's the psychological aspect. People tend to believe what they want to hear. Many investors saw Madoff as a legendary figure in finance, so any doubts were quickly brushed aside. It's like when you really want something to be true, your brain filters out contradictory information and focuses only on confirming evidence. This phenomenon is called confirmation bias, and it can cloud judgment significantly. Think about a time when you dismissed signs of trouble because the outcome seemed too good to be true. That's exactly what happened with Madoff. Investors saw consistently high returns year after year and convinced themselves everything was fine, even as cracks began to appear beneath the surface. But let's not forget that this isn't just about spotting scams, it's also about understanding how investments actually work. People need to know there's no magic formula for guaranteed profits without risks. Every investment has its pros and cons, and you must weigh them carefully before proceeding. Don't be swayed by slick marketing or charismatic pitches. Instead, dig into the numbers and details. In essence, Madoff's Ponzi scheme was a perfect storm of greed, misplaced trust, and regulatory gaps. It teaches us that protecting your money isn't just about avoiding obvious scams. It's crucial to stay skeptical, question everything, and educate yourself thoroughly. This vigilance is the best defense against future financial disasters like Madoff's. This is educational and historical, not financial advice. Madoff's scheme succeeded because many investors were looking for a steady income stream with seemingly no risk. They fell prey to the allure of consistent returns, which are virtually impossible in real markets without corresponding risks. The scheme promised around 12% annual returns consistently each year, which should have raised significant red flags due to its unrealistic consistency and lack of volatility typical in actual investment scenarios. Imagine if someone offered you a loan at 0% interest. It sounds too good to be true, and it's. Similarly, Madoff's returns were a mirage created by using new investors' money to pay off older ones, rather than from any actual profitable investments. This unsustainable cycle eventually led to the collapse when he couldn't find enough new investors to keep up the illusion. The real tragedy is how many people lost their life savings and retirement funds in the Madoff Ponzi scheme. Some investors had been with Madoff for decades, trusting him due to his reputation on Wall Street. But trust alone isn't enough. Conducting thorough due diligence is crucial. Always ask for transparency. How are returns generated? What specific investments underpin these gains? Another critical lesson: diversification is your friend. Spreading your investments across different asset classes reduces the risk if one investment performs poorly. Putting all your money into a single investment, as many did with Madoff, can lead to significant losses. Regulatory failures significantly contributed to the continuation of the Ponzi scheme. The Securities and Exchange Commission, SEC, had several opportunities to investigate Bernard Madoff, but failed to act due to poor oversight and lax enforcement. This underscores the importance of staying informed about regulatory developments and advocating for stronger protections. Skepticism remains a powerful tool in safeguarding investments. These principles can help you identify potential scams and protect your investments from future disasters. This is educational and historical, not financial advice.